So if you look at the global financial crisis, you had one of the worst recessions in modern history, and oil demand globally, even though so the price of oil got crushed, right? Actual oil demand only fell very little, right? So normal outside of the madness of like 2020, where we had this completely historic event, huge cliff in terms of oil demand. That was a very specific outcome. So putting that aside, even a severe recession only puts so much downward pressure on oil and gas in terms of the quantity that is used. Now the difference was in the global financial crisis, you had a whole decade of more and more supply coming online. And you went from super cheap oil up to $140 barrels of oil at one point, and then you crashed down to some crazy level. And then actually after a recession, you quickly went back up to over $100 barrels of oil. In addition, back then, oil companies were kind of expensive relative to the underlying price of oil. What makes this environment different is that oil companies are still not expensive relative to these prices. So there's a lot of pools of capital. They're not even allowed to invest in oil companies. Other ones kind of everyone has the same thesis, which is, this can't last. So the idea is like, they're so uncertain about oil prices, they don't want to own these energy stocks. And so in addition, we've not had much of a new supply cycle over the past, say, 5 years. So ever since oil fell off a cliff in 2014, there's been a sharp reduction in capex. OPEC is kind of, arguably out of spare capacity. And so I think that there's the supply side, in my view, somewhat more important than the demand side. And then especially when we get to a point where the United States is no longer drawing down its strategic petroleum reserve, right? So that's essentially a new form of demand if that just stops going down. And if China ever decides to come out of these rolling lockdowns, there's good data showing how significantly they've been holding down flights and then probably also automobile usage, right? So different types of fuels in China are well below their baseline already. In addition, this is where oil prices are with the dollar going straight up, right? And so imagine if that just not just falls. Imagine that just stops going up at the same pace it has been. It just kind of levels out for a period of time, especially in a number of currencies. If they pause, let alone pivot, if they just pause or they have to reliquify something, right? And if you get some sort of local top in the dollar, who knows what could happen to the dollar price of energy. And so I do think that there are reasonable concerns over the next 6 to 12 months about the sector. I think it's going to be a volatile ride. I would not be levered long, small cap energy producers, right? Because I think you're going to have a bad time if you do. But I'm structurally long with a multi-year view and uncertain enough about that tight supply demand dynamics. There's multiple headlines I could wake up to that would make me either a little bit more bullish or a little bit more bearish on oil over a 3 to 6 month period. But it's something that I'm willing to unlevered hold through this period of volatility because I think the underlying situation is very, very different than, say, the 2000s decade. So there's been no supply cycle yet, and there's only so much demand that can come off the market, and there's all these temporary forces that are already kind of artificially suppressing it as it is. So I look at things like price to cash flow over a multi-year period. I also look at things like dividend yields for these large caps because earnings change a lot more rapidly than their dividend does, right? And so generally in this environment, last time you had that huge uptick in oil, and you had a huge uptick in these energy companies, and right now, for example, they've been most oil companies are like their stock price is like down or sideways, over like a 15-year period, right? This is not some sort of bubble in energy equities, right? So even though they're raking in profits, they don't have exposure to much globalization, right? So they don't have to worry about like Chinese supply chain issues. They have basically good dividends, good cash flows. Many of them have stronger balance sheets. And so I generally find that a lot of them they've not kind of reflected the idea that oil probably has like a floor in the say 70. Doesn't mean it can't briefly go below that, but there's a pretty strong bid by either OPEC or the SPR once you go below 70, while the upside is who knows what the upside could be? I mean, oil prices could do what natural gas prices in Europe did, and it's unclear. And I'm talking about, like, say, a 5-year period, right? And so I think that the upside of energy prices is much bigger than the downside of oil prices, and that they're kind of pricing in something along of this like lower end of that range, as though that's going to stay there forever, or even go down. And so, for example, I look at Morningstar analysis of like energy companies, for example, and they'll generally assume like a return to the prior 5-year baseline of oil companies, which I guess that's fine. That's conservative, right? So you're valuing the company based on that, and that's a good thing to do. But then it's like, okay, what if that doesn't happen? What if you don't go back to 60, 70 oil? What if the new normal is $100 oil? Or what if the new normal becomes $120 oil, which again is still below the peak price you reached before the global financial crisis, let alone the fact that the inflation adjusted price. So it's not even extreme energy pricing at that point. And so I still think they're cheap relative to the range of outcomes, considering that we've not had any sort of supply response yet. So once we started to get that energy crisis in Europe, which actually came before the war, that came in the second half of 2021. Once that started to materialize, I became a lot more neutral and not strongly opinionated on the dollar index itself, because it's so euro heavy and it's weighted towards all these developed market currencies. And I became a lot more selective with which country specifically I'm talking about when I talk about a strong or a weak dollar. And so, again, going back to the prior point, for example, Brazil, the currency's held up very well compared to the dollar. So a lot of what we've seen, it's almost like a barbell. There's been severe weakness in developed market currencies. Most of them are energy importers, and they have so much debt that they can't raise rates enough. On the other end of the spectrum, you have a lot of frontier markets, obviously running into currency problems, as they always do when the dollar gets strong. Whereas if anything, there's been like a strong middle, right? So some of the major emerging markets, their currencies are either up or flat against the dollar in some cases, or they're down, but they're not as down as like even the major developed currencies, right? And so I think a lot of it is on a currency by currency basis. If you're a highly indebted country and you have a energy input problem, that's like the worst case scenario for your currency, because you can't raise rates enough to get the positive real rates, and that's basically an emerging market crisis for a developed market currency, right? Because you can't print energy in a similar way that emerging markets can't print dollars for their dollar-denominated debt. These Western countries cannot print energy if they have trouble getting it. And so, I've been very cautious over the past year about these kind of just financialized Western sovereigns, and I've been more constructive on countries like Brazil, to a lesser extent Mexico, India, countries that are either lower debt or that they have more commodity exposure. Even Canada to some degree. They have debt problems, but at least they have energy, for example. And so I think we have to be more selective with how we look at this. And then it's also, obviously there's been a huge rate. So when you go back to those top currencies, there's been a huge rate differential. So the Fed's hiked rates super aggressively. Powell thinks he's Volcker, while Kuroda is playing the 1940s playbook, where he's like, we're not even going to try. We're just going to hold rates super low. And so that's causing a huge differential. And it's fun, if you see the comments out of a lot of the Japanese ministers, they're kind of like, well, we're kind of fine with a lower currency. It's good in some ways, it's bad in other ways. They want to make sure it doesn't get too disorderly. But that's kind of the environment that we're in now. And as long as that dollar is screaming higher, it's unlikely to be good for most foreign assets. It's unlikely to be good for most domestic assets, because the foreign sector is still selling treasuries. And still, even in many, the Swiss, for example, they're not buying stocks like they used to be buying stocks, for example. And so that puts ongoing pressure. And so I think that continues until the dollar kind of stops its like vertical ascent. But I think it's, from an investor perspective, it's good to look on a currency by currency basis and look at their dollar-denominated debt, look at their reserves relative to GDP. Look at their energy situation. Are they net exporter? Are they net importer? Are they balanced, so that they don't really have a crisis from it? And I think those are the main variables to look at. So it's possible. The problem is once you give up on yield curve control, it's hard to get the market to, believe your next target, right? So in the beginning, the market was heavily testing their yield curve peg, and they defended it aggressively. And so the market has settled down trying to attack that peg, and instead they're just selling the currency. And so if they ever move that, it's hard to then defend the second one. It's possible that they will. Like I said before, I think they with 0.25%, I think they picked too low of a number. I think because they have 250% debt to GDP, they don't really have a choice to peg it somewhere. But I think that low of a level was probably unnecessary. But the one lever that they still have to pull, and they've already dabbled in it a little bit, is selling some of their reserves and doing interventions. And so one difference between Japan and Europe, I say two differences. One, Japan's energy situation is bad, but it's actually not as bad as Europe. Their prices did not blow out to the same degree, and then also I think they're more pragmatic. They're like, okay, we got to get these nuclear reactors back on quicker. Let's ramp this up. They don't really have, kind of the ESG politics to the same degree that we see over in Europe. They're kind of less ideological about how they want their energy to mix to look. Unlike Europe, they weren't reliant on Russian pipelines, and so obviously the fact that LNG markets were expensive is not great for them, but it's overall less of an energy shock than Europe, number one. And number two is they have more reserves, both in absolute terms and relative to GDP, than, say, a country like UK, right? So UK has minimal reserves relative to the size of their economy. Japan has over $1 trillion of treasuries, over $1 trillion of foreign exchange reserves. And so they have quite a bit of firepower to defend their currency. And one way to phrase it is you could almost, we showed the charts of what the treasury market looks like in terms of volatility and, illiquidity. Imagine if Kuroda really sells some treasuries, right? So he's, the question is who can stay solvent? Like, can China and Japan sell treasuries longer than the Fed can stay tight, given the state of the treasury market, right? And so there could be a period where, they sell enough treasuries, or they don't. All these places stop buying treasuries. The Fed has to reliquify, and you get some sort of slowdown, at least in the ascent of the dollar index compared to some of these currencies. And I think we're not quite there yet, but it's something to watch out for, because when I see people talking about the dollar screaming higher, I don't see enough people talking about that feedback loop of okay, if it gets as bad as some of the, kind of the most hawkish predictions suggest it will. You have to imagine what happens to those treasury holdings of some of those major powers.